So in accounting, it is possible to make decisions by comparing accounting figures with the other. So what I'm saying is that you compare a particular item in terms of the value of the item with the value of another item, okay, to have a view of both items in comparison, so as to make an informed or quality decision about a particular business, as contained in the financial statement, or as reported in the financial statement. So in this class, we're going to be looking at accounting ratio. So the bottom line here is that what you're trying to see the proportion or the fraction of one accounting item compared to the other. So when you try to do that, you are using accounting ratios to interpret or analyze the financial statement. So basically, what we are saying is that you use two different items, the value of two different items, and trying to see the relationship between those two items, okay, so as to make a particular decision based on the comparison of those two items. So the proportion or the fraction of one accounting item to the other when compared is what we call accounting ratio. So basically, the ratio is a tool used for analyzing financial statement. That is, you want to have some views about the figures contained in the financial statement. So you can use that to have an understanding of what has happened, or to make a decision going forward about the business. So aside from the accounting ratios, there are other approaches that can be used to analyze financial statements. So we can use trend analysis. Trend analysis simply means, studying how a business has performed over a particular number of years. It can be in the last 5 years, it can be in the last 10 years, it can be in the last 2-3 years, depending on what the objective that wants to be achieved. So basically, we refer to it as trend analysis. For instance, you can compare 2018 and 2019. Say, okay, 2018 there was a turnover of 20 million. 2019 there was a turnover of 22 million. So in absolute terms, we can say that there has been an increase of turnover by 2 million between 2018 and 2019. We can as well report that as a percentage change, which is 10%. 2 million is 10% of 20 million. So there's an increase, okay, by 10% between 2018 and 2019. So basically, your trend analysis can come in absolute form or in percentage change form. Another approach is the analysis of cash flow. Maybe a flow of cash. That is, you're trying to understand how the business utilizes its cash through operation, or how the business generates cash through operations, and how it utilizes or uses it in form of generating cash or spending cash in investment, financing activities of the business, as well as meeting the obligations of the business. So basically, you can as well analyze the cash flow statement, okay, to make informed decisions. Another approach is to analyze the value-added statement. Value-added statement tries to analyze or identify the value generated by the business and how the value is shared among the stakeholders. Who are the stakeholders of the business? Employees, government, the owners of the business, the shareholders, okay, financiers, it could be banks, it could be the venture holders. Basically, these are people that have stake in the business. So the value that the business generates in a particular period, how did you share it? So you can use that to make some informed decision. So basically, you get that by analyzing the value added statement of the business. Another approach is to look at graphical information, bar charts, graphs, pictograms, charts, okay, that are reported in the statement. You can analyze those ones as well to make informed decisions. So now we've been able to look at other approaches of analyzing financial statements. But here in this volume, we are concentrating on the use of accounting ratios to make informed decision by analyzing the financial statements of the business activities of the business. So if we must use accounting ratios, what are we going to get? What are the importance of using the accounting ratios? What are the uses of the accounting ratios? So one of the uses of accounting ratios is to reach a conclusion on investment. I want to invest in a business. Is it worth? How much am I going to earn on my shares? Okay, so these are some of the decisions that you can reach by using your accounting ratios. What is the possible profit I can get or return I can get on my investment? These you can get, or you can reach, or you can decide with the use of the accounting ratios. Another thing is you want to know the performance of the business over the time, over the years. Okay, in the last 2-3 years, what are the performance? How does it look like? How is the business doing? You can use accounting ratios to do that comparison. Another thing is you want to know the liquidity of the business. How is the business capable to meet its short-term and long-term obligation? You can use accounting ratios to do that. Debt collection. How are they active in collecting debt from people owing them? That's another thing you can use accounting ratios to achieve. How are they active, or how committed are they in paying people that the business is owing? Another thing you can use the accounting ratios to get. You want to predict, you want to project. Okay, how do you see the business performing in the next 2, 3, 4, 5 years, or even 10 years? You can do your projections, and then you can use accounting ratios to interpret some items. You want to get informed decision on stakeholders benefit. For instance, your employees. Is it time for them to get increased? Time for them to get bonuses? You can use accounting ratios to know if the business is liquid enough, the business is capable enough to reach out to such stakeholders in form of benefits. Another thing is you want to test the accuracy of the data in the financial statement, or you want to find some missing figures or data. So you can use accounting ratios to achieve that objective. So these are some of the importance of using the accounting ratio. So now we have the types of ratios or classification of ratios. We're going to be classifying the ratios into 3: solvency ratio, profitability ratio, and investment ratio. That we're concentrating in this volume. So the first one is solvency ratio. Solvency ratio helps to know how capable the business is to meet its short-term and long-term obligations at when due. Okay, when you need to pay your debts, are you capable? So the solvency ratios help us to identify that ability in a business. So here we're looking at some of the solvency ratios. The first one there is working capital ratio. Okay, we're saying how capable is the business to meet its short-term commitments. Okay, short-term commitments, short-term obligations, short-term liabilities. That was saying how capable, what's the ability to meet that obligation. So basically we are saying that the formula is current asset over current liabilities. You know your current assets now, then you know your current liabilities. I've taught you on liability items. If you go to our class on double entry for assets and liabilities, you'll be able to know what current asset is and what current liability is. So basically, your current asset over your current liability gives you your working capital ratio. You can also call it current ratio. Okay, so basically, you want to know how capable the business is in settling its short-term obligation. So the theoretical standard is 2-to-1. What we mean is that at every point in time, a good business should have 2 times its current liabilities in its current assets. What I'm saying is that your current assets should be 2 times higher than your current liabilities. If your current liability is 1 million, the standard is that your current assets should be 2 million. The next one is quick ratio. How fast are you capable to pay your short-term commitments? Okay, we don't want to start saying I want to sell products. No. If we have to take out looking for buyers to come and buy the product that we sell, how fast are we at what meeting current liability. So basically, we say current asset minus stock, because we're looking at the fact that you don't have to go and sell to be able to meet up with the obligation now. So the items you have should be easily convertible to cash, so you can settle your current liabilities. So we use current asset minus stock over current liability. So the standard here is 1-to-1. So at every point in time, your current assets should be able to cover your what? Current liabilities. Cash collection period. What time does it take for you to get your what? Money from your customers? You sell on credit. Okay, so how many days does it take for you to get what? Your money from your customers? That's what we mean by cash collection period. So we say trade debtors over credit sales times 365 days, measured in days. Cash payment period. How long does it take for you to pay your creditors? So we say trade creditors over credit purchases times 365 over 1, measured in days. Stock turnover rates. Okay, number of times. How many times have you bought and sold? When you sell products, you go and buy again. When you sell, you buy again. Okay, because you cannot buy without selling. By the time you buy, it's until you sell it before you go and buy. So how often do you buy and sell? That is, how often do you sell products that have been bought? Okay, so we have cost of sales over what? Opening stock plus closing stock divided by 2. So this opening stock plus closing stock divided by 2 is what we call average stock. So we can rewrite it as cost of sales divided by average stock. So your average stock is opening stock plus closing stock divided by 2. So let's continue. Solvency ratios, payables turnover rate. The number of times creditors are settled within the period. What I'm saying is, have you paid creditors 2 times, 3 times, 4 times, 5 times in this year? So you want to know that with the payable turnover rate. So what do we do? Credit purchases over average creditors. That's opening creditors plus closing stock creditors divided by 2. What's the value of a creditor at the beginning of the period? What's the value at the end of the period? Add it together, divide by 2. You have your average creditors. So credit purchases divided by average creditors will give you what? The payables turnover rate. The number of times you settled your creditors. Receivables turnover rate. The number of times your debtors settle you. Okay, so as a business, how many times did you collect money from your debtors? So we have credit sales over opening debtors plus closing debtors divided by 2. So this average what? Debtors. The next one here, debt to equity, more of what? A long-term solvency. Okay, so we have what we call debt to equity. What's the degree with which the business is financed with debt and what? Equity. So what I'm saying is that you're looking at what the shareholder or the shares in the business compared to what the loans that the business have. So what are the interest-bearing loans? You can have the debentures, you can have long-term loans, you can have preference shares. They all bear interest. So those loans compared to what? The shares, okay? The share capital of the what? Of the business. That's debt to what? Equity. So we have interest-bearing loans and shares, okay? What are the loans that have interest, or what are the shares that have interest? Okay, divided by your ordinary share capital. Dividend cover, okay? So we're saying how many times, okay, does your what? Your profit cover your dividend, okay? So you're trying to say, you're looking at the relation between your profit and your dividend, okay? So if your profit is say 1 billion, and then you declared a dividend of say 500,000, so the relationship between the what profit that you made and the total dividends what that you declared is what we call the dividend cover. So how many times can you find your dividends in your what? In your profit? So we have profit after tax divided by total what? Dividends. Okay, interest cover. Okay, don't forget that you borrow money and then you pay interest so that you can make profit. Okay, so now the interest that you are paying your borrowers, okay, or your lenders, sorry, the people that are borrowing money, people that are lending the business money, the interest you're paying them, okay, how many of it, or how does your profit cover the interest? Okay, so we have profit before interest and tax over total what? Interest. Debt to shareholders fund. What's the extent with which business debt is covered in the long term arrangement. So we're saying that you have your shareholders fund that's available to shareholders, and then you have your debts. That's what you have, external liabilities. So basically, relationship between your external liabilities and your shareholders fund is what we call debt towards shareholders. So what's the extent with which the debts that you owe are covered in the long term? So we have total debt divided by shareholders or fund. Proprietary ratio, also called ownership ratio. Okay, so we want to say the extent with which was the tangible asset of business are financed by the shareholders fund. Are we saying that the shareholders fund is doing well to finance tangible asset or not? I think it makes sense when you have your shareholders fund comfortably financing your tangible assets. It gives a lot of comfort on the part of the investor. So basically we say shareholders fund divided by what? Total tangible assets. So these are the solvency ratios in the short term and in the long term. So here we have efficiency ratios. We're trying to say, how is the business performing in terms of profitability? Is the business making reasonable profit to continue to survive? If I'm putting my money in the business, is there profit to pay me dividends? So you can use your efficiency ratios to know how a business is performing in terms of bottom line or profit. So here we have profit margin. Okay, profit margin. Basically, we're saying your profit that you made in a particular year, what percentage is it covered in the sales? Okay, so if your sales is 10 billion, the profit that you declared operationally, what's the percentage of that profit in your sales? That we call profit margin. So we say profit before interest and tax over what? Sales times 100 over 1, measured in percentage. Okay, the next one is markup, profit markup. You're trying to compare the gross profit of the business, okay, which is more like profit made before operational expense. Compare it to the cost of sales. Cost of sales is the cost of buying products before you sell them. So we have gross profit over cost of sales times 100 over 1. That's measured in percentage. Asset usage. Okay, how efficient is the business using its assets to generate income or to generate sales? Okay, so we have sales over capital employed. Capital employed is more like total asset minus total liabilities. So we have specific asset to sales. You want to know if you have like 10 various type of assets, how are you using each asset to generate income for the business? If you have, for instance, let's say furniture and fittings, equipment, plant and machinery, motor vehicles, okay, how are you using your furniture and fittings to generate income? How are we using your motor vehicle to generate income? How are we using your equipment to generate? How are you using your plant and machinery to generate income? That would mean by specific asset sales. So we say sales divided by specific asset. So if you want to know how you are using furniture to generate what? Income, sales over furniture and fittings. If you want to know how you're using equipment to generate what? Income, sales over what? Equipment. If you want to know how you're using your plant and machinery to generate income, sales over plant and what? Machinery. There, still on efficiency, we have return on capital employed. What's the profit derived or derivable, okay, through your use of business assets? If you put in business assets worth 1 billion, what is the profit you can get on that asset? That's what we call return on capital employed. So we have profit over capital employed, okay, times 100 over 1. It's in percentage, basically. Okay, remember capital employed is more like total asset and total liabilities. So we have stock turnover rates. Okay, number of times inventories are to be sold. Okay, so what I'm saying is, how many times did you sell products in a particular period? So we have stock over cost of sales times what? 365 days. So it's the number of days that what? Inventories are what? Are sold or turned over. Expenses to sales. You're measuring the impact of specific expense on the what? Sales. So What's the impact of, if you have, for instance, you have various expenses, rent, advertising, communication, transport. What's the impact of what? Communication on sales. What's the impact of transportation on sales? What's the impact of rent on sales? So specific expense on what? Your sales. So we say specific expense over sales. If you want to what, measure the impact of rent on sales, to be rent divided by sales times 100 over 1. If you want to measure the impact of communication expense on sales, communication expense divided by sales times 100 over 1. So that was saying, that would mean by specific what? Expense. So we can have expense percentage. Okay, so you're trying to say, okay, if total expense is 10 million, what is it broken into? Maybe let's say we have insurance, advertising, rent, communication, warehouse expenses. So what's the impact of each expense over the total expense? So you can have the impact of rent over the total expense. You can have the impact of communication expense over the total expense. So that will mean, so if I have rent, I can say rent divided by total expense. Okay, that will mean by what? Expense percentage. So here we have investment ratios or investors ratios. As an investor, you want to know if putting your money up, investing in what? A business in terms of shares, okay, is it viable? Is it something that makes sense or not? So you want to make an informed decision on your what? Investment. We use investment ratios. So we have earnings per share. How much is one share making? That's earnings per share. So we have profit after tax minus preference dividend over number of ordinary shares. Preference dividends are dividends paid to what? Preference shareholders. Preference shareholders are shareholders with preferential treatment. Go back to our what? Class on shares, you understand. So this is how we get our earnings per share. How much is one share making? Earnings yield, okay? What is the probable, what is the potential return on my share if I am what? Using market value. That is, if I'm buying the share from another what? Source, not directly from the do. I'm saying, okay, I'm going to the stock exchange, I'm buying the shares in the stock exchange. What is the potential return on that what? On that share? So we use earnings per share divided by market value per what? Share. Price earning ratio. If I am buying my shares in the stock exchange, how long will it take me to get back my what? My money? So we say market price per share divided by earnings per what? Share. Dividend per share. Okay, what is one share getting in terms of what? Dividend. So we say total ordinary dividends divided by number of what? Ordinary shares. Dividend yield. What is the potential dividends to be made on a share bought from the market? Okay, so we say dividend per share divided by what? Market value per share. Okay, times 100 over 1 to be measured in percentage. Book value of asset per share. If you have asset base of 10 billion, what is the value of one share in that asset? Okay, down by what? Asset book value, or to the ratio of what? Share. So asset book value per share, you want to share your assets among the shareholders. So if I have one share, how much am I getting in that what? Asset? So counter ratio has some limitations. What I'm trying to say is that despite the fact that it's a tool for analyzing finance statement, it has some limitations. One, if you have a manipulated statement, then you're going to make your decision based on what? Wrong figures or manipulated figures. If you are comparing businesses with ratios, okay, and then these two businesses have been prepared on two different what? Assumptions and two different policies, you might not be making a viable decision. It might be misleading because they are not prepared with similar policies. Okay, then there are some other factors that the ratio might not disclose. Take for instance a business that is doing well. Okay, so the deals, the sales is tied to an influential person that is a member or a shareholder in the business. The moment that person takes his eyes off and then puts attention to what? Another business, that deal might not be coming to this business, but that might not be made known to you. Okay, so you are saying that the business is doing well, so potentially to continue to do well. But if the deals are tied to someone in the business, and that person now focuses attention to other businesses, the new business might be getting the deals, while this one might not be getting it. So your accounting ratio would have told you that what the business has a good projection, a good what, a good forecast in terms of what profitability or income. Okay, but this is tied to what someone within. So once the person now shifts his attention, the deals might not be as lucrative as what as thought. So these sort of factors might not be what identified by the accounting ratio. Okay, this is an illustration on calculating somewhat ratios. So we have XYZ Nigeria Limited income statement for 2010. This is the income, this is the expenditure, this is the profit or loss. You can see there. And then we have the appropriation account, how the profit was shared based on what the approval by the board of directors. Okay, and then we have the statement of financial position here. Okay, so that's it. We have the non-current asset, we have the current asset, which is the total asset here. We have financed by what? Liabilities, short-term liabilities here, reserves, 177. So here we have the reserve with the short-term liability to be 177,600. And then we have the what? Authorized share capital, 2 million shares at $1 each. We have preference share of 326,000. And then we have ordinary share of 900,000. So when you add, you have total liabilities of what? 3,328,000. So they are now saying that what? From the information given above, you are required to calculate ordinary dividend per share, preference dividend per share, ordinary dividend yield, assuming that the market price of share is 3.5 kobo. We have book value of asset per share. We have working capital ratio, total expense to sales, and net profit percentage. So we already know the formulas of these things. So we just apply the formulas, calculate, and what? Interpret. So basically the first one says ordinary dividend per share. So what's ordinary dividend per share? That will be total dividend divided by number of ordinary shares. So from the question, what's our total dividends? Look at it here. 90,000. So what is the number of ordinary shares? Go to your balance sheet. 900,000 ordinary shares. So let's divide 90,000 divided by what? 900,000. You have what? 10 kobo. So dividend per share is 10 kobo. So let's go preference dividend per share. That will be total preference dividend divided by what? Total number of preference shares. What's the preference dividend here? 163,000 already calculated. What's the number of preference shares? Go to your balance sheet. 326,000. Okay. So that will be what? 163,000 divided by 326,000. That's what? 50 kobo per share. So each preference dividend is chasing or is going to have 50 kobo in what form of dividend. So ordinary dividend yield. Okay, they said dividend yield, assume that market price of the share is 3 naira 50 kobo. So if you have 3 naira 50 kobo, okay, as what the market price of the what share, what's the dividend yield? Okay, so that will be dividend per share divided by what? Market price of the share. So what's the market dividend per share? 10 kobo. Look at it here. What is the market price per share based on the question? 3 naira 50 kobo. 3 naira 50. Okay, so now you have what now? 10 kobo divided by 3.5. That will be 2.86%. Then the next one, we have book value of what? Asset per share. We already know how to calculate that. That will be asset book value by number of ordinary shares. So the asset, total asset there is 3,328,000. What's the number of shares? 900,000. Look at it here in the balance sheet. So we have 3,328,000 divided by 900. That will be 3 naira 7 kobo or 3 naira 70 kobo. That's what each share is having in the words in the asset share. So we have working capital ratio. What's working capital ratio? Current asset divided by current liabilities. That's the formula. So what's the current asset here? 450,000. Current liabilities here is what? 598,000. So we have 450 divided by 598. That's 0.75 to the ratio of 1. So that means your current asset here is not equating your current liabilities. In fact, your current liability is higher than your current what? Asset. Not a good position for what? Liquidity. The next one is total expense to sales. So what is the total expense to sales? So we have total expense over sales, okay, times 100 over 1. So what's the total expense here? Total expense in the question is 2254. Total sales is 3,320,000. So we have 2254,000 by 3,320,000. So we have 67.1%. So that means your expenses is 67.1% of your what? Of your sales. The next one is net profit percentage. So what's the net profit percentage? That's net profit as a ratio of what? Sales. So as a percentage of sales. What's the net profit here? 1,066,000. What's your sales? 3,320,000. Look at it in the question. Okay. Have you seen your sales? Your sales is your income here in the question. 3,320,000. So what's the formula? Net profit over sales times 100 over 1. So what's the profit? 1,066,000. Sales 3,320,000 times 100 over 1. That's 32.1%. So that means that your net profit is 32.1% of your sales. So basically, get the formula, apply them, okay, do your ratios and what interpret. These are illustration on accounting ratios. I encourage you to go through the class again, pick up questions and solve. If you have questions and clarifications, you can reach me on 08136506356 or send me an email, jeremiah.dusu@gmail.com. You can drop questions in the comment section. I'll be there to reply you with the right answers. Thank you.